Now for a quick review of sales tax payable. There's two ways to do the sales tax, the easy way and the not so easy way. The first thing to keep in mind with the sales tax is that businesses never experience sales tax expense because it is not an expense to the business. The business is just a collection agent for the government. The business sells a product, the customer pays the sales tax gets sent right to the government by the business owner. So sales tax always comes with payable attached to it. It is always a liability. Okay, so two ways to account for it. A company can keep track of the sales revenue and the sales tax separately. In that case, you know the amount of revenue, you know the amount of sales tax payable, and you can just do your journal entry, okay? The way most companies do it, or the other way of doing it, is they just throw all the cash or the receipts in the drawer, and then at the end of the period, they have to figure out, well, how much is sales and how much is sales tax? Excuse me, because all they know is that they got $609 in the drawer, and the sales tax percentage is 5%. Okay, so if you can remember how to do this, it's really cool. You just take the cash in the register, you divide it by 1 plus the sales tax percent, and that gives you sales revenue. Okay, so 609 divided by 1.05, 0.05 sales tax, 1 plus the sales tax percent, 1.05, and that gives you sales revenue of 580. Then you can take the 580 times 5%, and you'll get the sales tax payable of 29. You get the same journal entry as before, it's just you have to compute it a different way. There's a lot of ways you can't do this, and a lot of times students will get onto an exam and go, oh, do I multiply it? Do I divide it? What do I do? So if you want to understand the logic of it, I have that over here. And so this is sort of verbally how things happen, and these are the equations that should add up when you're done. So you take the cash in the register, divide it by the 1 plus the sales tax percentage to get sales revenue. So far, so good. Sales revenue times that 0.05 gives you the payable. And then this revenue plus the sales tax payable should get you right back to the cash in the register, because that's what's there. Okay. How does it work mathematically? And if you think like this, if you forget the formula, you can sort of derive it again, because you have the sales plus the sales tax equals what's in the register. So if we just convert this to X, so X plus 0.05X gives you the amount in the register. This is 1X plus 0.05X gives you 1.05X equals 609. And then if you divide it out, X equals the 609 divided by 1 plus the sales tax and gives you the 580. So if you just remember this and you know a little math, then you can figure it out. Okay, so you should always get the sales tax correct, because now you know all this. Income taxes payable are for corporations only, and they're a liability to corporations. They will have income tax expense and income tax payable. The income tax will not show up on any financial statements for proprietors or for partnerships, because the tax liability on those types of organization flows through to the personal tax returns of the owners or partners. So income taxes payable will be an account you will see only on corporate financial statements. Okay, and let's see. I think the next thing we get to are the employee-related liabilities, and I will do another video on that.